This is InvestTalk, independent thinking, shared success.
I would love to get your opinion about Otis Worldwide Corporation. Their symbol is OTIS. They manufacture and install escalators and elevators, but the part of the business that I find intriguing is the service side of their business. I wanted to see what your thoughts were on the company and if you thought it was a potential investment, what you thought a good entry point would be. Thank you.
So Otis Worldwide Corporation, ticker OTIS, is a manufacturer, installer, and servicer of both elevators and escalators, as well as moving walkways. Think those things you see at the airport that people frequently stand on when you know what, you're just faster if you walk on them. It's headquartered in Connecticut. They operate in, all over the world, maintaining nearly 2 million elevators and escalators. Now, 38% of their business is creating that equipment, right? Manufacturing that equipment. But 62% of that business is servicing existing equipment. Over the past 52 weeks, they're up 3.65%. They underperformed the S&P and their index, or rather industry, in the last 2 years. Year to date, though, they're up 5.09%, outperforming both of those categories. Now, one of the reasons why I would say that this company hasn't really moved much in the past year or so is because revenue is really not growing at all. 1.7% on an annualized basis, going back the past 5 years. And in fact, they only had about $61 million in new revenue from 2023 to 2024. Their net income grew pretty significantly, though. So it means their margins expanded, which, yes, they did, from 9.9% net margin to 11.5%. But that's supposed to fall again this year. Now, it's roughly $37 billion in market cap with a decent amount of debt, $8.7 billion in debt. And they've actually been growing their debt over the past couple of years as well. Their cash flow is steady. They've been buying back shares, which we certainly like to see. And frankly, you'll be seeing probably more from companies over this year. And they have a solid dividend, about 1.75% dividend yield. Now, recently, they did miss on earnings. So they did see a slight decline in their stock price from that. The service segment, though, did grow by far more than the manufacturing segment fell. And one thing that I do like about this company is that most of the revenue does come from servicing those existing elevators, but parts may become more expensive. And it's trading pretty high, 24.3 times forward-looking earnings, 23 times forward-looking price to earnings. So we're slipping growth and contracting margins, although I do like that this is a diversified business that does a lot of repairs on its own machinery, doesn't necessarily rely on new manufacturing. For now, it looks a little expensive to me. Going to have to pass on OTIS. That is Otis Worldwide Corporation. All right, let's answer another question. Let's take this one from our YouTube channel, and it is on ticker HSTM, HealthStream Inc. It says, I own HSTM, and after this week's earning report, I am down 11.32%. What are your thoughts on the company, and is it a good time to pick up more? The company has shown consistent growth over the last 5 years, and they carry very little debt. Do you think the sharp decline is justified? Well, over the past 52 weeks, they are down about 22 basis points. The only year in the past 6 years they've outperformed their industry and the S&P 500 is 2022. Past 3 months, they're down about 20% at 18.99. Year to date, they're down about 15.47%. Very, very small company. $818 million market cap. As noted, very little debt. About $20 billion in debt. And they don't even issue shares. They've actually bought back shares over the past 5 years. They pay a dividend, sits at about 44 basis points right now, which is about where it's sat since they started paying their dividend in 2023. Growth is happening, but I wouldn't necessarily say that growth is robust. And consistency isn't always good if consistency is low. They've grown at about 2.8% on an annualized basis over the past 6 years, which for a healthcare tech company isn't necessarily stellar, right? They offer workforce solutions, including learning management or staff scheduling, pretty much the back office work of healthcare. And so their business-to-business sales, not going too great. Their net income, though, rising at 7.1%, leading me to believe that margins have expanded. They have from 2021. They hit a low at 2.3%, with 6.9% last year, projected to be about 7% net margin this year. Let's take a look at those earnings. Well, earnings per share was 14 cents. Consensus was 16. It was a 10% miss. Revenue was 73.49. Consensus was 74.89. That's a 2% miss. And even with the drop off, they're still trading about 40 times forward-looking earnings, trading about 12.9 times cash flow. I would say mainly that drop off is a little warranted, right? It's not just about what your earnings were. It's about what your forward-looking guidance is as well. And forward-looking guidance did get downgraded a little bit. Right? They said in the full year 2025, they downgraded it to about $300 million, down from the previous estimate. And the reason why, those macroeconomic headwinds. So in spite of them also announcing recently that they secured a $14 million contract, you're seeing a company that growth has been slow. Margins have been narrow. Cash flow growth has been slow as well. And so couple on that, some headwinds looking forward, makes sense that it's dropping off 11 to 12%. So it's sitting about $26.88 right now, $26.88. I wouldn't necessarily sell it from here, but I don't know if I would buy any more. When we talk about individual companies, we're talking about it on a stock by stock basis, right? And frankly, I think compared to some of the other healthcare tech companies that I've seen that we've had questions about, this is not as good as them. That is HealthStream Inc., ticker HSTM. Let's keep things moving and play another listener question now.
Hi, my name is James from Hanford, California, and I'm calling about healthcare medical device industry. I'm looking to get into that sector and that sub-industry, and I narrowed it down to Thermo Fisher, ticker TMO, and Stryker. Those two are on my list, and I was just calling to see which one is cheaper, which one has more revenue and earnings per share growth moving forward for the next 2 or 3 years. I just want to see which one is the best one to pick up right now and at what price level. Thank you for all that you do. I learned a whole lot listening to you guys for 7+ years now. Thank you.
Alrighty. Well, we're going to look at 2 companies here, and I don't think we'll have time to look at both before the break. So let's tackle Thermo Fisher Scientific before the break. It is a medtech company. They create analytical instruments and equipment, specialty diagnostics, and laboratory products. They have a portfolio of reagents, instruments, and consumables used in biomedical and medical research. About 54% of their business comes from laboratory products, about 19% from life sciences solution, and analytical equipment, about 17% of their business. Now, it's a fairly large company, I would say, $153 billion market cap, with about $32 billion in debt, so not too much leverage on their balance sheet, not too worrisome there. Year to date, though, down 21.6%, past 52 weeks down 28.81%, and that's in spite of growing at 10.9% on an annualized basis. But you know what? If you dig into the numbers more, they haven't really grown much since 2021. In fact, they've actually fallen in revenue since 2022. Their net income has fallen as well, though it is set to rise again heading into next year. And their margins have fallen, though again, set to rise heading into next year. Trading about 17.6%. Forward-looking earnings, price to book 3.1, price to sales of 3.6. That is TMO. We'll take a look at Stryker when we come back, and hopefully we'll hear from you live because our phone lines never close. 888-99-CHART. To dive deeper into financial education, head over to InvestTalk.com. For the break, we were talking about Thermo Fisher Scientific, a pretty well-diversified company in the life sciences sector. Now we're going to talk about Stryker Corporation. Pretty big med tech company, about $146 billion market cap, only about $14 billion in debt. So very robust balance sheet. They have issued shares, though not too much, up from 376 million shares 6 years ago to about 382. They do pay a dividend, about 0.9% is where it sits right now. The revenue growth is comparable, about 8.7% on an annualized basis, but look how much smoother it is over the past 6 years. That is consistent growth. Similar with their net income, which in fact is supposed to grow from 2.9 billion to 5.1 billion this year, as their margins are set to expand from 13.2 to 20.8. Now, they are a little bit more expensive at 27.2 times forward-looking earnings, but that's about where they have been on average over the past 5 years. Over the past 52 weeks, it's returned about 15.63%, 6.67% year to date. You're making a choice between two companies in the healthcare adjacent space. TMO, diversified revenue stream, a lot of products, not a lot of reliance on the government. Stryker, though, large med tech company, a little bit higher dividend yield, certainly a little bit more expensive. If I had to choose between the two, I would probably go with Stryker, because the revenue growth is similar, the margins look better, the cash flow improvement looks solid as well, and they just have a real foothold on the med tech industry while also having a very strong balance sheet. Thanks for the call. Alrighty, let's answer another question. This one came fresh from the comment section of the InvestTalk YouTube channel. It's on ticker EXR. EXR is extra space storage. It says, do you think EXR is a good buy and hold? All right. Extra space storage, I'm going to guess, is a storage company. Look at that. It's a real estate investment trust. It operates through their self-storage operations, their tenant reinsurance as well. Self-storage making about 89% of their revenue. But the past 52 weeks, about 2.7%, down 1.58% year to date, though still outperforming the S&P 500, but underperforming its industry as a whole. Revenue growth about 20% on a year-over-year basis. Margins look pretty solid, as you'd expect with the REIT. Price to funds from operation, lower than it's been on average over the past 5 years, sitting about 17.8 times on a forward-looking basis. In terms of debt, they only have about $13 billion in debt on a $31 billion company. Their cash flow, though, skyrocketing through the roof. Their valuations, like I said, look pretty solid. Their profitability looks solid as well. They pay a decent dividend, 4.4%, which sounds really high, but that's about where it's been over the past 4 years. This is one of the areas of real estate investment trusts, this one being a pretty big one at $32 billion, that I tend to like. And the reason why is ask Justin, someone call in next time, and ask him about his storage unit and how many times he's told me he needs to clean out his storage unit. And it tends to be one of those sticky businesses. Not always the best performers, but tends to be a very, very consistent grower and a consistent business that just throws cash at you. And so if you're going to invest in the REIT space, I think this tends to be a decent sector to be in, decent sub-industry to be in. And as the balance sheet looks pretty strong and growth looks solid as well, I tend to like it. That is ticker EXR, Extra Space Storage, Inc. Alrighty. We already talked about it briefly, but let's talk more about it because it's important. And let's talk about what the Fed did and said today. Well, as I mentioned, they held rates steady at their recent meeting. 425 to 450 is that range. And Powell warned that sustained tariffs could lead to higher inflation, slower growth, and rising unemployment, aka a stagflationary impulse. And because of this, tariffs are complicating decisions. If you're the Fed, you have what I have referenced as the dual mandate, which is really a three-part mandate. One is the stability of the financial system, but step away from that. The other is worrying about unemployment, the labor market, and inflation. And typically they tend to move in concert, right? You have wages increase, labor market becomes tighter, it leads to prices being increased to the point where prices are too hot, and then you pull back on the labor market, and that leads to lower levels of employment, higher levels of unemployment, that slows down inflation. It's a push-pull. And the policy that they implement tends to affect those things in opposite directions. So the problem becomes when you have both things becoming worse at the same time, you lose a lot of levers of power. Now, even with this, even with the wait and see approach that the Fed, frankly, has had forever, rate cuts are still expected later this year. Earlier this year, people were saying, well, maybe the first rate cut's going to be in June. Guess what? Market was wrong again. And so the likelihood of that happening has certainly declined over the past month as we've learned more and more about Trump's tariffs. Now, at the same time, Trump has pressured the Fed to cut rates, calling the Fed stubborn, suggesting that Powell is often late in his decisions. But critics, myself being one of them, argue that rate cuts could backfire, right? They could fuel inflation even more at a time when costs have been historically rising, though they haven't been rising as quickly as they have in the recent past, but they are still rising, and you have the potential for more inflation from tariffs to begin with. Now, in spite of all this, the long-term inflation expectation still remains pretty stable. But, that's I think one of the issues that people aren't giving enough air to is oftentimes you think about, and people have discussed tariffs as being a demand side issue, right? Things become a little expensive. There's less demand for it because price elasticity of demand. But one of the issues is that you could create a COVID level supply shock. And so the Fed has to be very, very cognizant of that. Evidence of that potentially, well, you have businesses that were rushing to import things in Q1, which led GDP to be negative slightly. But also that cargo volumes from China have plunged 35%. So small businesses, large businesses are in limbo. None of this is new news on the day, but certainly interesting to hear from the man himself what they are thinking. Certainly anytime Powell speaks, the market listens. All right, let's pivot back to the InvestTalk voice bank for this question that came in earlier.
My name's David from Portland. I was just going to ask you what your take is on United States Steel, ticker symbol X. I just bought it a share. I listen to your podcast all the time. Thank you.
All right, ticker X, US Steel. I would say a storied company in the United States. If anybody's a Godfather fan, it's part 2, I think, when Hyman Roth says we're bigger than US Steel. Anyway, I'm really, really big Godfather fan. But besides the point, US Steel has had an interesting couple of years because during the Biden administration, there was talks of a buyout from Nippon Steel, Japanese company. President Biden blocked that merger. President Trump continues to block that merger. And, it's on the back of, a decade of deteriorating performance from the company. Now, it is a fairly large company, right? It's got about $9 billion market cap, not as big as it once was. Revenue growth, well, with the exception of the coming out of the pandemic, it's really fallen off, right? They grew from $9.7 billion to $20 billion in 2021. But ever since, they've kind of been trickling ever downward. At the same time, their net income has fallen. Also, keep in mind, pre-pandemic, they actually were losing money. Margins, again, out of the pandemic, fantastic. Everybody was building. Everybody was spending money. 20.4% net margin. Let's trickle back down to 2.5. From a balance sheet perspective, they're pretty levered. About $4.2 billion in debt on that $9.5 billion market cap. And their interest coverage ratio, as the most recent quarter, negative. Most recent fiscal year end, less than 1. Cash flow falling, margins falling, short interest at about 10%. And so, it's had a rough ride over the past couple of years. Frankly, I think this is, again, a situation where there are better investment opportunities elsewhere, specifically within the sector with better growth prospects, in, more importantly, better financial positions. Let's make it 2 in a row. Another question from 888-99-CHART.
This question is for the panel. The symbol is S as in Susan, P as in Paul, Y as in yes, D as in David. It's an ETF, and I would like to know at current prices, I have a small position. Would you add to it or just hold it or sell it? And I'll wait for your answer on your next podcast. Thank you.
Ticker SPYD, the Spider Portfolio S&P 500 High Dividend ETF. I love this description here. They offer a no-nonsense approach. Simple approach to high yield in the US large cap space. Essentially what they're doing is they are taking the most recent dividend multiplied by the dividend frequency divided by share price. That's it. They're taking the top 80 and that is what comprises their fund. Now it is pretty cheap because that is again a very simple way to go about finding high dividend yielding companies, or rather constructing a high dividend ETF. And as you'd expect, a lot of finance, a lot of utility, a lot of consumer non-cyclicals, decent amount of energy, not a lot of tech to speak of within this. And so, you're going to end up with a lot of large cap exposure, about 80% large caps, about 19.03% mid caps. And familiar names at the top. Philip Morris, AT&T. It's at about 79 names. Is it an equal weighted ETF? Yeah, it looks like it's an equal weighted ETF as well. So that's why you have a little bit more mid-cap exposure, overweight mid-caps relative to the overall index. All right, it's cheap. It's definitely cheap. Year to date, it's down about 2%, underperforming its index, which is the USA Investable Market High Dividend Yield. So that's going to be large caps through small caps. But I think one issue I have is sometimes simpler isn't always better. And Justin has a mug, or he had a mug. Might have broken the mug. Says it all the time, don't chase yield. This is an ETF that is constructed to chase yield. There are other ETFs, I won't mention them. You can find them, we've talked about them before. They may even track 100 names. And they look at payout ratio, they look at dividend yield, they look at dividend growth, they look at income growth. They have all these things that go into it. So it's not just that you're looking for high dividend yield, which could be a bad sign for a company. Prices fall off, your dividend yield's higher. Dividends aren't set in stone. And so although dividends can be a good way to look at a company for the stability of the business, how it returns cash to investors, capital to investors, this is in essence chasing it. And so if you're looking for a high dividend ETF, look for one that looks less at the number itself and more about what's driving it. That is ticker SPYD. Don't miss out on critical market updates. Subscribe to the KPP Premium newsletter for weekly insights delivered straight to your inbox. Let's go to Andy from Fresno, who has a question about Deckers and Adidas. Do you own them, or are you trying to choose between them, or what's going on?
Okay, so I have a position in Adidas, and I'm up just a little over 100% on this position in about 2.5, 3 years. And I was thinking about, not that I see anything wrong with the position, but I was thinking about selling it and moving that money over to Deckers because it's been down a lot and looks like they're projected to grow at a higher rate as compared to Adidas. So I just want to get your take on it.
It's a great question. Adidas, obviously a sports apparel company. I don't think I have to mention to many people what Adidas does. Deckers, they have a bunch of brands, Haka, UGG, Deckers brand. Most of their business comes from direct-to-consumer sales, about 43%. But I think, and I could be wrong on this, but it's definitely close because it's down 40.49% this year. It might be the worst performing name, a large name, in the S&P 500 this year. It's underperformed the S&P 500 by 36.2%. Now, it was up 3.24% today. One thing that I think is a little worrisome from the price perspective, though, is their EPS consensus estimate right now is ahead of their guidance for this upcoming earnings, which is set to go on May 22nd. I think both of these companies face similar headwinds, but differing headwinds, right? Adidas is kind of being chipped away a little bit at the athleisure brands that have risen in the past 5-6 years. And congratulations on a big win there from that position. But I think that one of my issues with Deckers is increasing cost potential from tariffs. I think that's one of the reasons why they're down so much this year. Now, should there be some relaxation, which certainly doesn't look like it's on the horizon, you could get a little bit of relief there. But, for now, I think, frankly, we're just outside of we're going to be within my 2-week window of earnings. And so if you want to make this move, if you do it in the next 2 weeks, you're going to be fighting with people taking positions for earnings. If you wanted to do a more conservative approach before you sold some Adidas and went into Deckers, I would wait until after earnings. Again, there's a likelihood that they don't hit consensus because it's above what they guided, and that could lead to further deterioration of the price from there. Thanks for the call.
Thank you.
And before we head off for the day, I want to touch on something that might float equity prices moving forward. And we talked about retail buying, which has certainly been helpful, and we've been in a blackout window because of earnings. But what we've seen is that companies are planning to spend $500 billion in buybacks, with $192 billion just announced last week. That's actually the largest weekly total announcement since 1995. Over the past 3 months, that total announcements reached $518 billion, the highest rolling 3-month total on record. And the reasons why are twofold. Companies are flush with cash, and there's uncertainty about making capital investments. And so if you're sitting on this cash and you see your stock price is lower than it was because of tariff uncertainty, and you don't know if you should expand, spend, then the best thing that makes sense for you to do is to buy back shares at this lower price. And so buybacks do twofold, right? They will boost stock prices, but also boost earnings per share because the number of shares goes down and there's also buyers in the market. So what sectors are leading the charge? Well, tech, financials. Apple announced a $100 billion buyback. Alphabet, a $70 billion buyback. Wells Fargo, a $40 billion buyback. Visa, a $30 billion buyback. Energy, materials, and utilities are avoiding these large buybacks programs so far, which is interesting because a lot of energy names are significantly down. Now, through earnings season, S&P 500 companies have beat Q1 EPS by about 7.8%, or rather they beat the forecasts by about 7.8%, well above expectations, giving them confidence to return capital back to shareholders. Now, there's an argument that it could be better spent on wage growth, on productive investment, but a lot of money from a lot of these companies has already been so sucked in by artificial intelligence and expanding their technology. And so with more buybacks coming, it's important to understand the dynamics that float markets. It's not always because the present value of future cash flows discounted has gone up. Sometimes market dynamics drive prices higher. That'll do it for today's episode of Invest Talk. I'm Luke Guerrero, and I thank you very much for being here today. And I encourage you to tell your friends and family members about our free podcast downloads on iTunes, Google Play, and Spotify, as well as our show, which they can check out over on YouTube. Now, if you want to talk to us, me or Justin, about your portfolio, head over to investtalk.com, hit the portfolio review button. We do a lot for our clients. We manage their investments. We hold their hands emotionally as much as they need it. We build them financial plans. We optimize their 401ks. We help them set up trusts and wills, deferred sales trusts, do a lot of tax advantage things beyond the investments that we're managing. It all starts over there on investtalk.com. Independent thinking, shared success. This is InvestTalk. Good night.